Hello and welcome to session 22 of our Series 7 exam overviews, brought to you by Passing Score, where you can get our apps and other helpful information at passingscorefinance.com. In this video, we'll be covering the last of our three parts on options, and let's get into our final topics here. There are interest rate options as well as equity options, which are the ones we've been looking at so far. In this case, we're really betting or hedging on changes in interest rates. It's important to remember that there's an inverse relationship between bond prices and interest rates. When one goes up, the other goes down. And we can have calls or put options. We can have an option to buy a debt security or sell a debt security. And just remember that interest rates are key to the option valuation. We also have something more directly tied to the interest rate called a yield-based call option. These aren't tied to a specific security, but rather to an underlying interest rate. These are just purely settled on a cash basis if they're in the money, and they're European exercises, which means they're going to go to the expiration date and settle or expire worthless at that time. And these are normally based on treasury securities. We also have yield-based put options as well. Again, there's no securities exchange, just a cash settlement at the end of the expiration of the option. And we have our formula here for calculating the return on the option. We also have stock index options. So instead of a specific security, the underlying of the option can be an index such as the NASDAQ 100, the S&P 500 are pretty typical, or more focused indexes on a certain industry, which we may be looking to hedge against. And these are valued at the end of the trading day to determine the option valuation. And our value is determined by the index value minus the strike price times the 100 shares that are typical for options contracts. There's also something called the VIX, or typically known as the fear index. This is looking at the volatility that's going on in the S&P 500. This is traded on the Chicago Board Options Exchange, and it's looking at volatility for the next 30 days. And again, this is valued at the index value at the end of the trading day. There's also a capped index option. This is an option that is automatically exercised at a given price. So there's a built-in feature to get out once that cap is reached. Because of that, it has a lower premium and transaction costs to trade in these kinds of options. We can also have currency rates that are tied to the option. So we can have foreign exchange. They can be denominated, I should say, in either US terms or European terms. That is, euros, for example, as the foreign currency per dollar, or dollars per foreign currency. Again, in this example, the euro. And you can see the difference, the zero point 0.8 in US terms is the same as a $1.25 per euro in European terms. There's also the interbank market for foreign currency. This is trading between large institutions or banks or other large clients. And as you can see, there's a certain time frames that they usually trade in: 1, 3, 6, 9, or 12-month intervals. Uh, there's certain, for foreign currencies, there are certain standards for how they're priced. For most of the currencies that we see here, they're 10,000 units per contract. And you'll see the exception here is the Japanese yen at 1 million units per contract, because of the way the yen is priced, is typically around 100 yen per dollar. So it gets a million units per contract. And we'll take a look at what that code is at the top, the XDB, in this case, the British pound, in the next example here. In this case, we're looking at the Australian dollar, and it's priced at 150, so we get $1.50 per Australian dollar. And the pricing per contract for the premium is 250. So we're going to multiply that times 100 shares for which is typical for the options contract. So what that 250 means is we're going to have a $250 premium, as you can see here. The total exercise then at this price is going to be $15,000 US. And we can see another example, in this case for Japanese yen, the XDN. This is a March 150, so the strike price is 150 times 0.0001 cents to get the dollars per yen. Our pricing is $2.50, so our premium is $250 for a total exercise, again, of $15,000. So you'll notice, really, we've only changed the decimals for the yen. Otherwise, the calculation is very similar to what we saw with the Australian dollars. So don't let that throw you off. It's just a change in this decimal conversion. But you see, we get the same exercise and the same premium that we saw before. The OCC is very important. They're the Options Clearing Corporation, and they're who you're going to trade directly when you're trading an option on an exchange. They're the counterparty, so that way they eliminates counterparty risk, the risk that the other side of your contract won't be able to pay when the time comes. This is all regulated by the SEC. And these are the different exchanges to which this applies, the exchanges that trade options. You might wonder if the price moves around a bit, that you're going to need new options to cover the new price range that the market is reaching. And this is the rules for how they determine what those intervals will be. For market prices $25 or below, you have 2.50 point intervals around the market price. For market prices, $25 and 200, you're going to have 5 point intervals, and anything $200 and above is going to have a 10 point interval. And there can be exceptions, so they can introduce new intervals if they feel like it's required to increase liquidity, if there's a lot of activity and there's a need for more detail or a wider range. There's certain cutoffs as to when options can be transacted, when they can be exercised. So these times can show up on the exam. So don't think that these might be too detailed to show up. They actually do get tested. So you'll have to learn these for the exam. These are the times and trading cutoffs for equity options. And here they are for index options. Again, very similar, but make sure you learn these for each of the different types because they might actually ask you to compare. For currency options, again, we have a similar on the business day prior to the expiration date. We have a 4 o'clock and 5:30 for the exercise cutoff, and just before midnight on the Saturday following the third Friday of the expiration month for currency options. We also have an fixed income option cutoffs, and these are a little bit different. You don't see a specific time for the trading and exercise, but there is for the expiration date. It's going to be that same midnight on the Saturday following the third Friday of the expiration month. And T-bill options expire at March, June, September, and December. So we have quarterly expirations for those. Leaps are a long-term version of an option. So options are typically a short time period, but leaps can reach up to 39 months. And because of that, their time value is going to decline more slowly, especially at the beginning. So this gives you an opportunity as an investor or hedging to do so over a longer time period. So if you do want an equity option for longer time periods. Those are available and they're called LEAPs, long-term equity anticipation securities. LEAP contracts have slightly different rules than regular options. They're American style exercise and they expire in January on the Saturday after the third Friday of the month. That's important to know. And they're typically created just once a year. We also have certain rules that the CBOE, again, the Chicago Board Options Exchange, has in place to make sure that there's smooth flow on the options markets. Any important to know is all the executed trades are submitted to the OCC. So they're keeping track. They're the counterparty. They're making sure that counterparty risk is at least minimized. And the OCC will credit you on the following business day after you're done with your option. The order tickets are required to have certain information on them. And again, this is important to know for the exam. So a lot of these are pretty obvious, whether it's a buy or sell, a call or a put, the number of contracts, but it's important to review these and know these for the exam. Options have certain rules as to their exercise as well. Some interesting things here are that if you're in the money, if you're going to make money at the expiration, it's going to be automatically exercised for you. So you don't have to worry if you forget or you're waiting to the last minutes of missing of being able to exercise just right at the last minute. That's going to be done for you at the end of the trading day. And there's a settlement in 3 days if there's a stock buy or sell involved as well. Stock splits are, of course, going to affect our options because the number of shares are going to change. So the economic value, the market overall value isn't going to change, but the number of shares and the price will change, and they're going to move again in the opposite direction so that the total is the same. But if you have a stock split, you're going to have a decrease in the strike price and an increase in your contracts, and the reverse for a reverse stock split. We can see that for an odd stock split here. We have a 3-for-2 stock split. That's going to change our strike price to $13.33 and increase our contracts, conversely, to 150 shares. And we can see that same effect with no matter what, but the total is going to equal the same. So in our second example here, we have shares going down to 66.67 shares, but the price is going to go up to $30. So we get the same total. Stock dividends are very similar. Again, there's no real economic change. It's more a signal to the market. But if we have a 10% dividend, we're going to increase our shares per contract from our standard 100 that we've seen up to 110. But then our price is going to go down so that we have, again, the same total. We're going to decrease the price. Not just the market price, but the strike price of the option will change as all. Will change. And for cash dividends, there's no change. That's just money being distributed out to shareholders. So that's not going to affect the number of shares or the strike price at all. And that's it for our options section. Finally, we've done number 3. If you have any questions, please feel free to email me at john@passingscorefinance.com. Check out our apps at passingscorefinance.com, which has more detailed information. And good luck on your exam.